Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at AppLovin.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, we'd really appreciate it.
And before we jump into the wealth building context today, I just want to quickly mention StockOracle.
Right.
It's an AI-aided stock research platform, and we actually have a special 14-day trial link right below in the description.
Just a quick heads up, that is an affiliate link. So, the channel may earn a commission at no extra cost to you.
Exactly. And we always like to remind everyone, this is not financial advice.
No, definitely not.
StockOracle is not a trading signal service, and it's not real-time market data. The AI insights and valuation estimates can be incomplete or just plain wrong. So always verify the important facts yourself.
Yeah, you really have to do your own homework. AI is a tool, not a crystal ball.
Right. So getting into AppLovin today, imagine you're running a company and you grow your revenue by 53% in a single quarter.
Which is just a massive number.
Oh, it's huge. You're pulling in almost $2 billion. And your reward, Wall Street completely erases a fifth of your entire market capitalization in one single afternoon.
It completely defies standard business logic, doesn't it?
It really does. I mean, Main Street looks at this and sees a cash printing machine just operating at absolute peak performance.
Right, but Wall Street, they see a trajectory breaking in real time, and they just hit the sell button without even hesitating.
Yeah, and that's the paradox we're unpacking today. If you've ever held a high-growth tech stock, one that missed expectations by just a fraction of a penny.
And then you just watch your portfolio bleed out.
Exactly.
Yeah.
This analysis really gets to the core of why that happens. We're looking at market psychology, hidden structural threats, and honestly, the critical importance of reading the fine print in those financial filings.
Because the surface numbers on earnings day, they rarely tell the whole story.
No, never.
Especially when the underlying business model is caught in this proxy war between tech monopolies.
So to really understand the violence of this crash, we first need to look at the fundamentals. We have to establish the immense success that set those expectations so ridiculously high in the first place.
Yeah, let's look at the trailing fundamentals from late 2025, because they read like an investor's absolute fantasy.
They really do. We are talking about an 88.37% gross margin.
That's nearly 88 cents of every dollar brought in as gross profit.
Let that sink in for a second. And furthermore, their net margin was sitting at 64.29%.
What's fascinating here is what those margins actually say about the mechanics of the business.
Right.
AppLovin operates these digital ad networks and software platforms, connecting mobile app developers with advertisers.
Right.
They aren't managing physical supply chains. Really.
No warehouses, no shipping delays.
Exactly. They aren't dealing with raw material inflation. Once their underlying software architecture is humming,
The marginal cost is basically zero.
yes. The cost to facilitate an additional 1,000 or even 1,000,000 ad transactions, it approaches zero. They have essentially built this incredibly efficient, automated toll booth.
It's a self-reinforcing data loop. More users playing games in their network generates richer behavioral data.
Which feeds directly into their recommendation engine.
Right, and that engine delivers higher conversion rates for the advertisers. So those advertisers then pump even more of their marketing budget back into AppLovin.
Which just funds further expansion. It's a massive flywheel.
And in the fourth quarter of 2025, that flywheel resulted in a 66% year-over-year revenue jump, up to $1.66 billion.
And their adjusted earnings per share nearly doubled in that same time frame to $3.24.
So they're like an Olympic sprinter who just won gold. I mean, they're wildly profitable, they're growing fast. So what on earth happened on August 7th?
Well, let's talk about the stumble. Q2 2026 hits.
Ooh.
AppLovin posts $1.92 billion in revenue.
Which, again, represents massive 53% year-over-year growth. By any conventional standard, that is a spectacular quarter.
It is. Yet the stock absolutely plummeted 19.66% in a single trading session.
Hitting a new 52-week low of $335.67.
Yeah, and if you zoom out, the stock is down a staggering 55% from its September 2025 peak.
Down 55% for a company growing at over 50%. It sounds insane.
The violent repricing comes down to the mechanics of consensus estimates. It's how growth stocks are inherently valued by the market.
Right, because a stock price doesn't represent past achievements.
Exactly. It represents the present value of all anticipated future cash flows.
So analysts are building these really complex discounted cash flow models based on a very specific growth vector.
And the consensus estimate for Q2 projected $1.94 billion in revenue.
But they hit $1.92 billion.
Right.
I mean, they missed the revenue mark by roughly $20 million on a $2 billion base.
It's essentially a rounding error in the accounting department.
Right. So isn't a 20% drop for a tiny revenue miss just a massive overreaction? Or is this market saying there's a deeper crack in the foundation that we aren't seeing on the surface?
Well, institutional investors in algorithmic trading models, they don't care about the $20 million.
Okay, what do they care about?
They care about the derivative of the growth rate. AppLovin grew 66% late last year. Now they are growing 53%.
So it's the deceleration.
Yes. And the forward guidance they issued for Q3 also came in lighter than the street anticipated.
Got it.
When a deceleration from 66 to 53% combines with a soft forward guide, it permanently alters the terminal value of the entire enterprise.
Because Wall Street was pricing AppLovin with the assumption that this aggressive compound annual growth rate would stay elevated for years.
Exactly. The moment that growth vector bends downward, the models recalculate a fundamentally smaller future business.
And the valuation just collapses instantly to reflect that revised reality.
But you're right to ask about the foundation. That 20% haircut suggests something much deeper than just a tweaked financial model.
Okay, so let's get into the catalysts and the real risks here, the structural threats.
The market is incredibly efficient at sniffing out structural decay. Morningstar actually assigned AppLovin a narrow economic moat rating.
Narrow, okay, which points directly to vulnerabilities in their business architecture. I mean, they have some defensive characteristics, but they are highly susceptible to the major ecosystem owners.
The predators here are Meta and Google.
Let's talk about Meta first, because the mechanics here are just fascinating. A few years ago, Apple introduced the App Tracking Transparency Framework on iOS.
Right, which fundamentally blinded a lot of traditional ad tech. It required explicit user permission to track them across different apps.
And Meta initially really struggled to attribute ad conversions on iOS without that granular data.
But AppLovin adapted to that privacy shift remarkably well. They utilized contextual signals and their massive footprint in the mobile gaming space
to basically infer user behavior without needing the explicit cross-app tracking that Apple banned.
Exactly. They effectively rammed massive market share and billions in ad spend while Meta was, retooling its infrastructure.
But Meta didn't just walk away from that revenue permanently?
Oh, definitely not. They have poured billions into AI-driven probabilistic modeling.
They're leveraging their massive scale, their Advantage Plus shopping campaigns, and their vast first-party data to bypass the need for Apple's identifiers entirely.
And now they are aggressively reclaiming that untracked iOS inventory they previously lost.
Okay, let's unpack this for a second. It's kind of like building a beautiful, highly profitable mansion, but you're building it on rented land.
That's a perfect analogy.
Right. The land is owned by Google and Apple.
Right.
And now the landlords are raising the rent and threatening eviction.
That is Morningstar's core argument for the narrow moat. If advertisers are forced to consolidate their ad spend, they will inevitably default to the platforms with infinite reach and unassailable first-party data ownership.
So AppLovin is a highly intelligent middleman, but when giants like Meta and Google decide to close the gap, the middlemen get squeezed out of the margins.
Precisely. And Google is attacking the foundation from a completely different angle, too. Have you seen the stuff about Project Genie?
Oh, wow, yes. Project Genie. It's an AI platform designed specifically for game creation.
Right. And mobile gaming apps are the fundamental lifeblood of AppLovin's ad network.
They rely on that specific ecosystem to generate ad inventory.
So, if Google democratizes game creation through AI to the point where anyone can use a text prompt to instantly generate a fully functional, playable mobile game,
it introduces an existential threat to the economics of the whole ecosystem.
Exactly. It comes down to the basic principle of scarcity.
If the barrier to entry drops to zero, the market floods with infinite supply. And when the supply of gaming inventory goes to infinity, the value of advertising within that inventory just plummets.
Because AppLovin relies on a somewhat curated ecosystem of hit games and established studios,
Right. A hyper-fragmented app store filled with like millions of disposable AI-generated games completely breaks their current aggregation and monetization model.
The external threats from big tech are massive, but honestly, institutional money might be even more terrified of what's happening internally.
Yeah, let's pivot to the regulatory red flags in the bear case here, because it is seriously compounding the market's fear,
The SEC is actively investigating AppLovin's data collection practices.
which is never something you want to hear.
No, definitely not. And this probe was triggered by a combination of whistleblower complaints and short seller accusations.
Alleging that AppLovin has been actively violating terms of service to gather their data. I mean, the stock previously suffered a 14% single-day drop just on a Bloomberg article discussing the existence of this probe.
Regulatory scrutiny in the ad tech space is just incredibly toxic for valuation.
But the risk here isn't necessarily that the SEC levies a massive financial penalty, right?
Yeah. A company with 64% net margins can absorb a fine. That's just the cost of doing business.
The real systemic danger is the knock-on effect of platform retaliation.
Yes. If an SEC probe formally confirms and documents that AppLovin circumvented Apple or Google's developer terms of service to harvest user data,
Then those platform owners have the perfect, legally bulletproof justification to just revoke AppLovin's API access.
or ban their software development kits entirely, it would sever their oxygen supply overnight.
Wow, because Apple positions itself aggressively as a champion of consumer privacy.
Right, so ejecting a massive third-party ad network for violating privacy policies, that's a massive public relations win for Apple.
But it serves as a death sentence for the ad network. The data pipeline would instantly dry up.
And that terrifying regulatory backdrop makes the insider sentiment data absolutely chilling.
Yeah, let's talk about sentiment, because this is wild. Over a trailing 90-day window, company insiders dumped a net 252,863 shares
We are talking about 190 individual sell transactions by executives.
against a mere 9 buy transactions.
It's a mass exodus, and it's occurring while the stock is plunging to new 52-week lows.
Which is a huge red flag. I mean, institutional investors watch insider flow meticulously through those Form 4 filings.
They do, and look, executives sell stock for a variety of personal reasons, right? Tax obligations, diversifying their portfolios, maybe buying real estate.
Sure, sure. But an aggressive, highly skewed liquidation pattern at depressed valuations sends a very clear signal to the market.
It indicates that the management team, the people with the most intimate knowledge of the SEC probe and the platform dynamics, do not view this massive price drop as a buying opportunity.
Think about it from a passenger's perspective. If you see the ship's captains quietly putting on life jackets and heading for the lifeboats right at the exact moment the regulatory inspectors board the vessel.
Do you stick around to see how the voyage ends?
Exactly. The rational move is to head for the exits alongside them. It provides perfect context for Morningstar assigning a very high uncertainty rating to the stock.
The range of potential outcomes over the next 12 months is just incredibly wide, and the downside scenarios are catastrophic.
But, with executives bailing and the SEC circling, the stock feels radioactive. Yet, there has to be someone taking the other side of those trades at $335.
Right, every market has two sides. Deep sell-offs often create highly asymmetric opportunities for capital that's willing to absorb massive volatility.
So let's look at the technicals and the contrarian bull case here. Because Seeking Alpha recently upgraded AppLovin to what they call a buy rating.
And they attached a massive $722.50 price target.
That implies the stock could more than double from its current crushed valuation.
Their thesis seems entirely anchored on a drastic valuation reset. AppLovin is now trading at a PE ratio of 28.5 on a trailing 12-month basis.
This is the classic intersection of value investing and growth investing, isn't it?
Exactly. If you believe the core business model is not structurally broken and you think the SEC probe is just manageable noise,
Then paying a 28.5 multiple for a software company producing 64% net margins and growing top-line revenue over 50%. That is remarkably cheap.
it sits substantially below Morningstar's calculated $360 fair value estimate.
And from a purely technical analysis standpoint, the immediate requirement for any bullish reversal is reclaiming that $359 price level.
Right, because that line served as the prior 52-week low. Breaking below a long-term support level creates a bearish structural braided down on the charts.
They need to push back above that line to convince algorithmic traders that the post-earnings drop was an emotional overshoot rather than a fundamental collapse.
But the technical chart is really just the psychological reflection of the business operations. Fundamentally, everything hinges on the upcoming Q3 performance of Axon 2.
Axon 2, their AI-driven recommendation engine.
Yes, because Q2 suffered from lighter-than-expected model improvements from the system.
And tech investors right now, they have zero patience for AI platforms that don't immediately deliver exponential returns.
None at all. AppLovin management has to prove in Q3 that Axon 2 is actually delivering tangible, undeniable improvements to e-commerce ad revenue.
They really have to successfully break out of the mobile gaming silo. If they can demonstrate that Axon 2 effectively captures massive e-commerce and retail advertising budgets, it vastly expands their total addressable market.
Demonstrating re-accelerating growth in a new vertical would instantly change the narrative.
But that bullish outcome is entirely contingent on a clean resolution to the regulatory risk. It's a completely binary setup.
It really is. The SEC probe must conclude without triggering any terms of service retaliation from Apple or Google.
If they secure a clean bill of health on the data privacy front, and Axon 2 performs, the valuation likely re-rates violently upward.
So bringing it all together for a final verdict, the tension here is just palpable.
You have an incredibly efficient, high-margin cash engine growing at a blistering pace, but it's currently paralyzed by a multi-front war.
Right. They are fighting an SEC data collection probe. They're battling a crisis of confidence driven by a heavy insider sell.
And defending their rented land against trillion-dollar giants, leveraging infinite resources. So when we look at bullish score or investment rating for the long-term view,
It's highly volatile. The upside is massive if they clear the regulatory hurdles, but the downside is stepping in front of unresolved competitive freight trains. It's a high-risk, binary outcome.
the coming quarters will really determine if AppLovin joins the pantheon of unkillable digital platforms, or if they become a textbook cautionary tale of a highly profitable middleman just squeezed out of existence by the platform owners.
And it leaves you with this provocative thought. If a company boasting nearly 90% gross margins and elite algorithmic prediction engines cannot survive the squeeze from Apple and Google,
Is the future of the internet simply a series of impenetrable walled gardens where only the landlords generate wealth?
it really begs the question of whether independent innovation can even exist at scale moving forward.
It's definitely something to mull over. Well, that wraps up today's analysis. If you found this breakdown valuable, please remember to subscribe, like, and leave a comment below.
We love hearing your thoughts on these setups.
And don't forget to check out the special 14-day trial link for StockOracle in the description. Again, it's an AI-aided stock research platform, but it's not financial advice.
Right, and it is an affiliate link, so we may earn a commission at no extra cost to you. Always verify the AI's insights and do your own due diligence.
Keep questioning the consensus, and we'll see you on the next one.